So this month, we're going to be talking about how tariffs affect real estate. In the past, we talked about market cycles, mistakes high net worth individuals make, and also NJ market tips was our last one from last month. That was a very popular one. But what's common now in the news and the headlines are the trade wars and the tariffs that are going into effect here over the already into effect and going into effect over the next few months, and how that could affect real estate. So I'll talk for about 45 minutes about the pros and cons of what we're seeing right now. We're going to start a little bit on the pessimistic side, but then the second half of the presentation will be a little more optimistic. So bear with me. If you have any questions as we go along, please put them in the chat or the Q&A. I'm going to answer all questions at the end here. If you have any technical difficulties, trouble hearing me or seeing me, just write that in the chat as well. All right, so quick disclaimer here. This is not a solicitation for funds, tax advice, or legal advice, but I'm going to go over the research I provided here about tariffs and how they should affect the real estate market. A little bit about People's Capital Group. We've been investing in real estate here and helping people build and preserve their wealth in New Jersey real estate over the last decade plus. So in 2013, Seth Martinez and I created People's Capital Group with a goal to bring great opportunities, great real estate investment opportunities to people that want to own real estate in high demand locations, generally within an hour commute to Manhattan. We primarily focus on buying A, B, and C real estate that's in need of some value add. Often rents are far below market value, especially for the B and the C properties. Units are outdated, lack of amenities. So we reposition those assets with our in-house property management company. And then we produce a cash flow for our investors and refinance and sell over time as well to create multiple liquidity events for our investors. We've done about 300 transactions here in the northern New Jersey market over the last 10 to 15 years. And we focus on helping high net worth individuals, family offices, and accredited investors build and preserve their wealth strictly through North Jersey real estate here with our in-house property management company. So I'm going to talk about how tariffs are likely to affect the real estate market, how investors can maximize profits in real estate while tariffs are in place, how trade wars can affect your real estate investment profits, also why this could be an opportunity for real estate investors. Let's get right into it here. So first of all, how tariffs are likely to affect real estate. Well, from what we've seen from our research here, we are expecting some potentially negative impacts and positive impacts as well. It's hard to say exactly. So again, the first half of the presentation is going to go over some negative impacts, and we'll kind of focus on some potentially positive impacts as well. Higher material prices, so tariffs on imported building materials like lumber, steel, and aluminum will directly increase the cost of building new real estate, and that's going to impact construction companies and the price of new real estate ideally as well. A reduced supply, right? Tariffs could lead to supply chain disruptions as builders seek alternative sources or materials, potentially causing delays in construction projects. As it's harder to get these materials quickly, timing is already, especially in New Jersey and other blue states, it takes a long time to develop real estate. It can take 2 to 3 years to get approvals on developments, and another 2 to 3 years to develop, depending on the size of the asset as well. Obviously, smaller developments can be developed faster, but larger ones take a longer time. So the longer it takes to get your supplies in, the longer those developments will take, ideally costing more to those developers and construction companies as well. So this all can lead to higher home prices. As construction costs rise, builders may pass these expenses on to consumers, leading to higher home prices. Right? Also, reduced supply leads to higher home prices as well. So just the longer it takes to hit market and the more those buildings cost to create, that's going to all push prices up ideally. And that can also lead to slower market growth. So just the amount of trades you see in the real estate market. Higher costs could lead to a slowdown in the housing market with fewer sales and potential delays in construction projects. So, if you're a realtor or a mortgage lender, that can slow down your business as well there, which you've already seen with a lack of supply in the market. A lot of realtors and mortgage brokers and title companies and so on are struggling. So that situation can continue with higher tariffs. That can actually fuel that scenario as well. And higher expenses for homeowners and landlords. So increased costs for building materials will translate for higher expenses for homeowners, whether they're renovating a new home or investing in rental properties. Seth Martinez and I, we have about 200 units throughout northern New Jersey here. And a big part of our costs are materials. We're constantly renovating these properties, especially when we buy an old, outdated, Class C property. We're repositioning. You're buying a lot of materials, doors, windows, flooring, lighting, kitchens, baths. So all these materials, if the price of them go up, that can increase your cost to the landlord. Or if you're putting an addition on your home, or is building a new home, these can increase in cost if tariffs increase the cost of materials. All right, so that's some of the negative there, but how can we maximize our profits? All right, what are some ways to take advantage of a high tariff or trade war scenario? Well, first of all, we want to invest in the long term, and as an incentive to develop products in the U.S. increases, right? So ideally, more factories, more jobs created here. It's going to take a while for that to happen. But there has been a lot of companies that are saying they're going to be moving production to the U.S., especially if tariffs remain in place for a while, which has yet to be seen. But ultimately, down the road, over a 3 to 5 year period, that can create a nice organic growth in our economy. More jobs equals more housing, more people moving to an area requires more services, and requires more housing for those service providers, and so on. It's an exponential effect and can really improve a lot of those areas where those factories might be going in or those companies might be moving headquarters. So ideally, more companies will develop products in the U.S., leading to organic economic growth, which would be phenomenal. Not government jobs or false growth, just good organic growth. I've also read that jobs in factories can actually produce a lot of additional jobs in research and development, and other service jobs and management as well. I've read some statistics that one job in production can equal 9 additional supplementary positions being required. So that could lead to a lot of additional job growth in certain areas where these headquarters are being moved to or factories are being built. A focus on affordability, right? So if prices do increase for houses and products in general, and there's inflation with products or just a higher cost of products and housing, consumers will have less disposable income and will be more likely to seek more affordably priced housing. So therefore, you may want to focus on, more Class C and Class B properties, or Class A and more areas that are better priced, or even a build to rent here is another popular term we see a lot more of these days, where you're building a real estate development to rent those out to individuals. Generally, renting tends to be less than owning a home, especially as interest rates increase or remain high. Of course, interest rates play a large factor in that. But renting is quite popular these days. So you want to focus on potentially owning build to rent opportunities, and also repositioning existing apartment buildings that are in more affordable areas, and perhaps not high-end luxury. Of course, now there will be a place for that, as there's always a demand generally for Class A real estate, but maybe you want to acquire Class A real estate that's a little more on the affordable side, and in areas that are not in super high rent locations, or more modest rental price locations, and more affordably priced housing. Excuse me. Again, I'm dealing with a cold here. That's why my voice is so harsh. So bear with me here. Population centers. So areas where there's already a large population and a short supply of housing will likely see the largest increase in housing prices. So that's one of the reasons we love investing in New Jersey. There's a huge demand for housing here. There's really an insatiable demand for housing, large population, And a lot of these cities in New Jersey continue to grow, and the demand for housing cannot keep up with the population. There's more demand than supply. As you see these population centers tend to grow, jobs and companies tend to move to more highly populated areas where there is a stronger, more educated workforce, and that leads to a higher demand for housing, and that's a constant cycle to keep your housing demand high and your prices strong and your rental prices strong as well. So, again, there can be arguments to be made for the Rust Belt and areas like that where factories could be coming in, but also areas where populations are strong. And that's one of the reasons we love investing here within an hour commute to Manhattan on the Jersey side. Very strong, high population numbers here in the most densely populated state. I talked about build to rent and repositioning apartment buildings. At least in New Jersey, there's a lot of outdated vintage apartment buildings. That means older apartment buildings that don't have the amenities that tenants are seeking, or the updates that tenants are seeking as well. So we buy these older properties, we reposition them, we renovate the units, we improve the management, we input amenities into the building, we make them a nicer place to live. We're therefore able to increase the revenue on the property by increasing the rent roll, and that allows investors to make a higher return on their investment. So that's been a pretty strong strategy over the last decade, and we continue to see a demand for nice quality rentals that aren't extremely high priced either. See, when you buy a vintage apartment building and you reposition it, you can afford to charge a more modest rent, and a lower rent will attract consumers who are paying more for other items and maybe pressed more financially and have less disposable income. Finally, warehousing, office, and industrial and factories. If tariffs have their intended effect, companies will start producing products in the U.S., leading to an increased demand for industrial property, warehousing, office, etc. Obviously, office has been hit very hard ever since COVID, but there is a lot of areas where office is actually coming back rather strong, other areas where it's still struggling. But getting into even data centers, areas like that, there's a lot of capital coming in for new development in the U.S. And actually, if this has the intended effect that the current administration wants it to have, then we will see a growth in factories and industrial, office, and warehousing, and that'll also require more housing in those areas also. So it can be an exponential positive impact there. And owning those pieces of real estate can be good. Industrial has a great return on investment, often if purchased at the right price. I know many investors that do well with warehousing as well. Factory, we don't really build much in America anymore. So if you can somehow get in on those areas that are being developed for factories, or just owning the real estate around it, that can be great for your real estate values also. All right, now let's talk about trade wars and how our markets and our real estate portfolios can be affected if everyone's putting tariffs on other countries and the U.S. here. So here's a bit of a positive spin as I was researching this about how trade wars could affect your real estate portfolio. So a lot of economists argue that this could potentially happen here. We could see lower treasury prices. So if trade tensions escalate and everyone's putting tariffs on imports, now a lot of other countries already have very high tariffs on U.S. imports. You look at Canada, China, and that's the argument for tariffs. We're really being unfairly treated by a lot of these companies, and that's a fair argument. It is a little ridiculous when you start to look into how high the tariffs are for certain imports in Canada or China, right? Other countries, Europe, right? And that's one of the reasons the current administration wants to push back on having our own tariffs. Now, the effect of it is still yet to be determined. However, many economists say that this could lead to increased trade tensions, could flow capital from riskier assets like stocks into treasury bonds, which would ideally be pushing yields lower potentially. Now, lower treasury bonds could lead to a drop in rates, right? If fears of global slowdown intensify, mortgage rates could drop significantly, improving affordability and spurring demand for housing. As we saw in the last 2 years here, a little over 2 years, as the Fed has been increasing rates really over the last 3 years, um, we've seen a direct correlation in commercial real estate pricing. Now, I don't think you could say the same actually so much for residential pricing, at least in northern Jersey here. Residential prices have stayed surprisingly strong. They've actually grown over the last 3 years, not at the rate they did before the rate hikes, but they've certainly slowed, but they're still very strong. So if you want a nice, residential home here in a nice town in North Jersey, you're looking at a bidding war, right? So now, with commercial real estate, we have seen the expected impact of rising interest rates, which is lowering property values. Commercial real estate has dropped about 20% across the board in the country, and we see that in North Jersey here. In fact, we're working on buying a building right now in downtown Newark, a beautiful 63-unit Class A building with rents about 10 to 15% below market value for $23 million. And this building was under contract for $32 million 2 years ago. The seller didn't quite cooperate. The deal fell apart. And now, with rates increasing and property values dropping, it's a great opportunity for a company like ours to come in and buy this property for a pretty decent discount. There's a lot of value add to improve management on the asset. There's about 14 vacancies. So it's a Class A building that was built about 4 years ago in a great location, right into the Prudential Center in downtown Newark. But it gives us an opportunity to improve the asset over time, increase it to a much higher cap rate. It would grow the revenue over about a 2-year period, and then do a refinance and create a large liquidity event for our investors, and then cash flow for a few more years, and eventually sell it for another liquidity event. And we'd never be able to buy this property at such an incredible price if interest rates did not increase, right? If the interest rates stayed low, I'd still be bidding $32 million for this piece of real estate, and it wouldn't make sense. It wouldn't pencil out. It's actually easier to buy real estate now with rates high. We see a really perfect time to get properties at a great price, especially as we do expect rates to drop into the future. And that we don't price that into our underwriting, but that would be great if they do, right? That would allow prices of commercial real estate to increase, cap rates to compress. So that's ideally what some economists predict for the future. And this theory continues here with if there's a drop in rates, then we would see with an existing housing shortage, which we definitely have here in North Jersey and many other parts of the country, and years of pent-up demand, which we still see here as well. Lower rates could reignite bidding wars nationwide, right? That's going to really increase property values overall, not just for single-family homes, but for rentals, for commercial real estate, and pretty much all real estate. As interest rates drop, pretty much every economist will predict that real estate prices increase, especially in commercial real estate, because it's really closely correlated. So in this scenario, this would be great for our real estate values. It would allow you to have an increased property value and a lower interest rate. You could refinance. And if you recently bought a property in the last 2 to 3 years, you probably have a high rate. I know I bought some real estate and I locked in around a 6% rate. Let's say rates drop to 5 or 4.5. I'm going to refinance. I'm going to do a cash out refinance. I'm going to harvest that equity growth, put some tax deferred money right in my pocket, my investor's pocket, and lower our interest rate for the long term. That could also help increase cash flow. Even if you're increasing your debt amount, you might still have a reasonably decent monthly payment and be able to just lower your interest rate long term, take advantage of those lower rates. Who knows how long they would last, right? So this is one scenario that some economists predict, and this is a very positive scenario. And I personally hope this is the case, but of course, no one knows what the future holds. So we want to go over all possible scenarios. So let's talk about where is the opportunity right now? Right. So where's the opportunity with trade wars coming? Where do we see the capital flowing to most likely? Here's a couple predictions here from a few economists as well. All right. So secondary markets. If construction costs surge in primary markets due to tariffs on materials, developers might shift their focus to secondary cities where land and labor are more affordable. So the idea here is, of course, imagine yourself developing in downtown Manhattan, right? One of the most high demand, most expensive places to develop. Well, what we've seen actually already a lot of builders do is go across the river into the boroughs, or New Jersey, North Jersey, which is kind of like similar to like Hoboken's considered the sixth borough, right, of or Jersey City, the sixth borough of Manhattan, right? So of New York City. So in this case, we do think that would indicate growth for New Jersey. We know a lot of people that follow us and tune into these webinars are New Jersey real estate investors, as that's what we focus on. That's a lot of what we teach about as well. So for our Jersey investors out there, I think this is a good indication that demand in northern New Jersey real estate, generally within an hour commute to Manhattan, which we focus on, should remain strong. And as core markets like Manhattan become too expensive, the lands, the cost of materials increase, a cost of labor can increase with an increased amount of deportations as well. Then you might see a lot of those builders and developers move into secondary markets. Northern New Jersey is considered a secondary market, and there's many, many secondary markets out there, and a lot of investors invest in them. So keep an eye on secondary markets as tariffs increase the cost of real estate development. They may become much more attractive to keep costs low for real estate development. Alternative investments. So as a volatile stock market, which we've seen a very volatile stock market. Now, part of that is because the current administration shoots from the hip a little bit, and that's kind of Trump's style, that you never know what he's going to do, which kind of keeps a lot of his adversaries of other countries on their heels. And that's, love it or hate it or love it, that's kind of how he negotiates. And it sometimes works, right? So, but it also has side effects. It creates a volatile stock market, so people don't always know what to predict. And it can be hard for business owners too, right? You could have tariffs one day and no tariffs another day. So we need to settle down a little bit with the strategy here. And I think that'll happen in time. But right now we are in quite a volatile time where the stock market's going up and down and up and down. The stock market is normally quite volatile. That's one of the things people don't like about the stock market. That's what they do like about real estate, is ideally it's less volatile. But one of the reasons stocks are so volatile is because they're highly liquid, right? You can buy a stock at 1 o'clock and sell it at 3 o'clock, right? So that's an attractive part of stocks. They're very liquid. But what that creates is a lot of volatility, right? And prices fluctuate quickly. Now, with real estate is notoriously non-liquid. Right? Our investments are generally 3 to 5 years. So you're invested for the long term. Now, the positive of that is that you see less volatility, right? If you want to exit an apartment building you own, it's a process. It's like a 6-month process, right? You got to call a realtor, get different PPOs done, determine who you're going to go with. There's a 30 to 60-day marketing period. Then you're reviewing offers. Then you have an attorney review period. Then you have a due diligence period. Then you got to give them time to close their loan. This all takes about 6 months. For commercial real estate, as minimum. It can take longer for larger buildings. So what that creates is an illiquid asset, and that creates a less volatile market. So commercial real estate prices move much more slowly. And a lot of people actually like that, right? The lack of volatility in the market is what investors will seek as you see higher volatility in the stock market. So we may see more capital flow into real estate, especially commercial real estate syndications, such as what we do here at People's Capital Group, where we pool capital together amongst dozens of investors and buy large scale apartment buildings. So people can own a piece of an apartment building completely passive and not have to deal with the headaches of being a landlord, tenants, toilets, and trash, they say, right? So but still get all the benefits of owning real estate, like cash flow and tax depreciation and large liquidity events. So that may become a more popular option for investors, which in turn would fuel and increase the price of commercial real estate. Finally, lower rates. So if interest rates lower, some landlords will have a chance to refinance into a lower rate, as I touched on an earlier slide. That would create liquidity event and a lower cost of debt. Seth Martinez, my business partner, and I, we love refinancing our real estate. In fact, when rates were low, it was like a field day, right? And then we were able to refinance our real estate and lock in nice low interest rates for long periods of time. What's beautiful about a refinance is you can harvest equity growth And you want to do it wisely. The bank's not going to give you more than the property can cover in the debt service coverage ratio. You don't want to over leverage your asset. Banks don't allow you to do that these days anyway. But as long as you take out a healthy amount of debt on a property, and the tenants will pay down that debt for years to come, then you can refinance very successfully on assets over time, as long as you're growing the value of them by increasing the rent roll and the revenue, which we do here with our in-house property management company. So the idea is you harvest the equity growth through a cash out refinance, and that allows you to put cash into your pocket, your investor's pocket, and it's a tax-free liquidity event. Now, if you sell the building down the road, you can be taxed on that money you pull off the table. But if you don't sell the building down the road, or you do a 1031 tax deference in the future, when you do sell, you could continue to defer those taxes. And that's a great tax strategy. In fact, it's often how the rich get richer, that 1031 tax strategy. So what's our conclusion for tariffs here? Well, what I find is invest for the long term, right? Anytime you're investing in general, stocks, bonds, real estate, you really do want to have a long-term strategy. And I know with stocks, a lot of people can day trade and things like that. That might be, or crypto, that might be a way you make money. I'm not familiar with that strategy, but I know some people do well with it. But I have also read that the majority day traders actually lose money. And most savvy investors, such as Warren Buffett or so on, are going to suggest investing for the long term in strong companies. We suggest the same thing for real estate. Don't react to the headlines. Don't dump your properties or your stocks based on headlines. Take the market as it comes. If prices are high, well, consider selling. If interest rates are low, consider refinancing. If prices are down like they are now, buy or invest. Play the market as it is. We can't control the market, right? Invest for the long term. Expect to hold your real estate at least 5 to 7 years. If you're penciling out a deal and you have to dump it, in a year or something like that, then that could be a tough scenario, right? You want to invest for the long term. The longer you plan to hold an asset, the more likely you are to see that real estate market, right? If you're planning to sell when cap rates are low and prices are high, but you have a 7-year window to time that sale, well, then you're more likely to find that time when you could sell it, when prices are high and cap rates are low. Or, of course, looking to refinance, right? Then you're more likely to see a market where you have lower rates. So, go with the market. Don't go against the market. Invest for the long term. Don't panic over headlines. One thing I learned when I was researching this topic was that you could pretty much Google any question here that I put forward and get 2 exact different answers for it, right? The same presentation, I noted that prices for real estate could go up. And I also noted that prices for real estate could go down. So, you're welcome. That's pretty much the answer we have here. We don't really know the exact effect tariffs are going to have on real estate, right? It probably depends which side of the aisle you lean towards as well. A lot of people say, well, this could ultimately create a boom in America, a golden age where we actually develop things here and produce products here, and companies move their headquarters back here and build factories here. A lot of companies are talking about huge multi-billion-dollar investments in America. That could be great for your real estate values. That could be great for job growth and so on. Other talking heads say no, prices are going to go up. It's going to create a recession. It's not going to have the desired effect. We're going to pay more for exporting and importing, and all around it's going to create problems. So, it probably depends which news channel you watch and how you think this is going to affect America. And that's kind of goes to how we're divided here in America politically. But the bottom line is, don't react to the headlines, right? Everyone's selling you something at the end of the day, even news articles and news channels, right? So often we're trying to get, they're trying to get our clicks too. So beware of that, right? The bottom line is, I think that in a pro-business environment, with an area where we're having lower taxes, more of an incentive to have your development done here in America, build your product here in America, move your headquarters to America, there will be some short-term pain, but I believe in the long term there'll be gain, and we will see a more positive economic environment here in America in about 3 to 5 years. I don't know if it's going to take that long. It could be less, it could be more, but I think the idea here is that we want not so much free trade, but fair trade, right? It's a very popular term we see these days. And that means that if it's if one country is going to charge us ridiculous tariff to import products to their country, well, we should charge some type of tariff back to try and have more fair trade. Now, the exact effect that's going to have remains to be seen. Chances are prices go up in the near term, but over time, it incentivizes companies to actually build and produce in America, which would be a great thing to see as a lifelong American myself. So I think personally, we'll see some short-term pain for long-term gain. So again, invest for the long term, don't react to the headlines, and play the market as it comes. Right now, prices are down. I think it's time to buy. I'm scooping up deals right now for pennies in the dollar compared to what I would have to pay for them 2 or 3 years ago. It was much harder to buy real estate 2 or 3 years ago. I was buying real estate at 4.5 to 5 cap rates. That's ridiculous. We were locking in interest rates at 5.5 to 6. That's negative leverage, right? That's not really a great market to be buying in. We had to have a lot of value add to make sense of those assets, meaning we had to be able to increase rents on those properties by 30 or 40% to make sense of the investment. And that's the types of real estate we had to buy. Now I'm locking up Class A real estate that's mismanaged, motivated developers and sellers in high demand locations. And these developers and these builders just want to exit these assets. They're not particularly great at managing real estate. They're great at building real estate. And since prices are down, they have been down for a while, these sellers are motivated to exit. That means I can buy properties that used to be selling at 4.5 caps. I could buy those at 6 caps now. All right. So that means I can get a much better price on more attractive real estate. So I think it's a great time to be buying real estate right now as interest rates are high and prices are down. If interest rates increase, if interest rates lower, then we're going to see prices increase, right? So that would make it a harder market to buy in, but a better market to sell in and a better market to refinance in. So right now is a good time to be, in my opinion, buying and investing in real estate, and then we'll see where the market goes in the future. A lot of the economists predict a more expensive real estate market in the future. So that would indicate now is a good time to buy. Here's a little bit about People's Capital Group. Here's our 5-year plan. We recently closed on a property, growing our assets under management to $40 million. We're currently repositioning that asset. We have our team there improving the management of the building, our in-house management company. Our contractors are renovating the units. We're inputting laundry in the basement and storage in the basement, creating additional forms of income. We're cleaning out the trash from the backyard, and we are inputting a barbecue area back there and a jungle gym, a little dog walking area. And we're just cleaning up the building overall and renovating units as they become vacant. So as we reposition that asset, we'll go to refinance over 3 years and then sell it eventually as well. We also are working on acquiring a couple Class A buildings right now, as I was explaining, at discounted prices here in northern New Jersey. So we plan to raise about $20 to $25 million this year and acquire 1 to 6 assets here in northern New Jersey for a discounted price. And we're also going to be completing a refinance or sale of 1 to 2 assets this year as well to create large liquidity events for our investors. In 2026, we plan to raise $25 to $50 million and acquire about $50 to $100 million in assets and sell or refinance 1 or 2 assets as well. 2027, we'll increase that raise to a little over $50 million and acquire about $100 million in assets. We'll plan to also sell or refinance 1 or 2 assets in 2027. And then 28 to 29, we plan to begin harvesting those larger assets we've bought over the last 3 to 4 years, creating additional liquidity events for our investors. Here's that's me on the left, Aaron Fragnito. I focus on working with clients and investors and making sure they have their monthly updates and quarterly financials. They're kept abreast of exactly what's going on with their investments. I host a monthly podcast called the Passive Cash Flow Podcast. We have about 170 episodes. I also wrote and taught a course at Rowan University called Real Estate Entrepreneurship. And we do monthly educational masterclasses here about different real estate investment topics. In fact, I'll be doing a walkthrough of a building tomorrow, just to kind of invite only. Few investors are coming with me to walk through a building tomorrow at 10 a.m. in Passaic, New Jersey. That's the 42 unit we just purchased there. So if you do want to check that building out in person and you're an accredited qualified investor, I'll put a link in the chat to schedule a call with me, and we can discuss meeting over at the property tomorrow at 10 a.m. I'll probably do a public walk through that property in late April or early May. So keep an eye out for that email as well. There's Seth Martinez. Seth handles our operations. He's managing our management company. He's handling the operations of our current asset and upcoming assets as well. I primarily underwrite the equity investments with our underwriting team. Seth handles the operations once we acquire the asset. Together, we've done about 300 transactions in New Jersey. We manage about a $40 million portfolio here throughout northern New Jersey. Lena Delgado handles our property management. She has over a decade of property management experience. She manages our staff here, our leasing staff, our contractors, and so on, to make sure our tenants have a high quality experience. You know, a happy tenant equals a happy investor, as we say. Dana Sargenti is our bookkeeper. She makes sure our ACH deposits go out on time and our financials are sent out on time, and our K-1 tax forms that were just sent out to investors as well. So you get quarterly financials, quarterly cash flow distributions when available to investors, and annual tax returns done for you here at PCG. Create a completely passive investment experience in high demand North Jersey real estate. We generally have about 4 to 8 crews working at any given time. We work with a number of independent contractors. We have leasing agents that specialize in leasing out these units for to high quality tenants. You want to make sure you vet your tenants from the start. A good way to avoid evictions and drops in cash flows to lease to good tenants from the start, and that requires working with good leasing agents to do that. We also have a number of content specialists. We have webinars, masterclasses, podcast episodes, tons of content, ebooks on our website, peoplescapitalgroup.com. You can check it all out there. It's all free. We don't sell anything educational wise. We just offer it all for free. We have IT professionals with our client portal. So we have an investor portal that you can log on to as an investor. There you can check out all your monthly updates, your quarterly financials. Those are also emailed to you. Take a look at your distributions you've gotten from your investment, and your K-1 tax forms are uploaded there as well. So it's a completely passive investment experience. It's kind of like having an account at Ameritrade Financial or something like that. You log onto your account there online on the portal. You can see how your investments are doing, but instead of stocks, it's real estate. We work with a number of virtual assistants. We keep a lean, mean operation here. Tax specialists and 1031 intermediaries. We do work with 1031 capital on a case-by-case basis. If you're thinking about selling a property, or you are in the midst of selling a property and you want a 1031 into a passive investment opportunity, then schedule a call with me and we'll talk about what we can do here, what we have coming up for 1031 investors. I'll put a link in the chat to do that. We work with attorneys as well, all different types of attorneys, probably about 7 to 8 different types of specialized attorneys. This includes landlord-tenant court, residential attorneys, commercial tenants attorneys, LLC and corporate attorneys, SEC attorneys, affordable housing, and so on. You want to make sure you work with the right attorney for the service you're seeking. We also have property due diligence and acquisition experts. We have a very professional underwriting team that used to work with UBS, Fortune 500 company. We work with broker dealers, realtors, bankers, real estate brokers, the whole gambit from A to Z, so that we work with some of the best people in class. We source off-market deals through wholesalers and realtors. We don't buy deals sitting on the internet. We buy off-market deals that the average investor would never know about, and that's how you get a discounted price in a high-demand market like North Jersey here. So we just want to say thank you to our investors. Our success is your success. We have over 100 investors that invest with us, many since 2013. We would not be succeeding without the support of our loyal investor base. About 83% of our investors reinvest after a liquidity event. So thank you for your business. Right now, we are filling up a couple more spots on this 42-unit apartment building in Passaic, New Jersey. This is targeting a 19% IRR, internal rate of return, that's annualized, and 1.9x equity multiple to investors. We have a couple more spots on this one. We already bought it in December. We're already repositioning it. This is the building I'm showing to select investors tomorrow at 10 a.m. If you do want to take a look at this property tomorrow at 10 a.m., let me know. Reach out to me in the chat, or I can put a link up for you to schedule a call with me as well. You can also respond to the email you received for this webinar. If you're a qualified investor, we can meet out there. If tomorrow doesn't work for you, we could perhaps schedule time in the future to take a look at this building. The minimum investment is $50,000. It's a 5-year investment. A 1.9x equity multiple means that on a $100,000 investment, you'd expect to walk away with about $190,000 in total, including your principal return. That payout is between cash flow, refinance, and a sale of the asset over a 5-year period. It pencils out to about a 19% annualized internal rate of return. You can see here on the left or the right, the type of targeted cash on cash we predict from this investment. Starts off low at about 2.6% return in the first year as we reposition the asset. We're moving tenants out, we're renegotiating leases higher, we're renovating units as tenants move out, and we're leasing those units up for fair market value. We're implementing amenities in the property and investing that CapEx to reposition the asset. As we do that, our cash flow grows ideally to 4.8% year 2, 9.2% by year 3 as we stabilize the asset. Then we go to refinance, very beginning of year 4, month 37. We're talking about an 80% return of investment capital at month 37 through the refinance. And then we go to sell the asset end of year 5, creating another liquidity event as well for investors. In total, as I said, about $100,000 investment, you'd expect about $190,000 in total from this investment. We're already distributing cash flow to investors on this building. We distributed our first cash flow check in January based on 2024 Q4 cash flow and interest earned on investments, invested capital. And this was a mismanaged asset. Rents are about 30% below market value. A lot of value add on this, backyards filled with trash, the basements are filled with trash. We'll put laundry and storage down there, create amenities for the tenants, and additional income streams as well. It's located about a 55-minute commute into New York City. This is an off-market deal we bought for a discounted price, and we purchased this asset in December of 2024. So we already own this building. It's already cash flowing. We're already repositioning this building with our in-house management company. We've raised 87% of the capital at this point. We don't necessarily need all the CapEx money right now. We've got a $1.1 million CapEx budget. So we're not actively marketing this out through email blasts or social media marketing, but we do put this out to new investors who we are looking to build a relationship with. Our goal is to always build a relationship with new investors, and that's how we build our company and our investment firm through the years. The majority of our investors are referrals from other satisfied clients. So we want to extend this property to accredited investors. An accredited investor is an individual who earns $200,000 individually or $300,000 with their spouse, or has $1 million net worth, not including their primary residence. Okay? So again, that's an accredited investor. That's a $200,000 individual income, $300,000 including your spouse, okay, either or, okay, or $1 million net worth, not including your primary residence. So it could be any one of those three. If you're not an accredited investor, you can still schedule a call with me. I'll put the link in the chat here when I wrap up. And that will allow, we could talk about what we have for non-accredited investors. We do have a debt fund that pays 8 to 11% annual interest. We accept accredited and non-accredited investors into that debt fund, but you have to qualify as either a sophisticated or accredited investor for that fund. For this particular opportunity, we only have 13% available. Again, we're not actively marketing it out, although we may have a family office come in and kind of fill up the final spot over the next 30 days. I am showing this property to investors tomorrow at 10 a.m. If you want to take a look at this property, let's get in touch. We can show you the asset. Tomorrow doesn't work for you. I can let you know the next time I'll be over there with investors. Usually every couple of weeks, I go out there to show investors the asset. On this property here, we have a $1.1 million CapEx budget. We already have enough money for CapEx right now, about $500,000. We're just finishing off the final CapEx raise at this time. We don't really need the money right now, so we're not actively marketing it out, but we do open this up to new investors interested and qualified as accredited investors to invest in this opportunity. So if you have any questions, please put them in the chat there. If you feel like this opportunity is a fit for your investment goals, or you just want to learn more about it, or our track record here, our past performance of People's Capital Group, I'm going to put a link in the chat